Today's market moves weren't just a bounce. They reflected a calculated shift in how investors are weighing geopolitical tail risk against a hardware reality of the AI cycle. Markets staged their most significant relief rally since the start of the Iran conflict. We saw a risk-on move that finally allowed growth-sensitive assets to breathe. The S&P 500 climbed just over 1%, while the Nasdaq led the charge, gaining more than 1.1%. The primary driver was a sharp retreat in energy. Crude oil, which had been threatening to break $102 earlier in the morning, plunged over 4.6% to settle near $93. This drop provided a much-needed cooling effect on bond yields, with the 10-year Treasury retreating to 4.22%. Perhaps most telling was the volatility collapse, as the VIX fell over 13%, signaling that the blind panic of the last few days has transitioned into a more calculated form of hedging. The catalyst for this shift was a pivot toward diplomacy. Markets began pricing in a non-military resolution to the shipping freeze in the Middle East, following news that a major diplomatic summit might be delayed, specifically to focus on reopening the Strait of Hormuz. For the first time in weeks, the permanent blockade narrative was challenged by a diplomatic mediation narrative. At the same time, hardware innovation reminded the market why it was so bullish just a month ago. NVIDIA's unveiling of its new Rubin architecture at the GTC conference essentially dispelled the growing fear of an AI plateau. It signaled that the demand for high-performance computing is still decoupled from the broader macro slowdown. Institutional money executed a violent mean reversion trade today. We saw capital aggressively rotate back into technology and consumer discretionary, the very sectors that had been treated as duration victims just 48 hours ago. The energy as a bunker trade was largely abandoned as crude fell, revealing that much of the recent move into energy was tactical rather than structural. Interestingly, Bitcoin surged over 4%, while gold and the US dollar were weak. This suggests that Bitcoin is increasingly being treated as high beta liquidity, a sponge for excess cash when the immediate threat of a geopolitical blowup recedes. However, beneath this relief rally, a physical fragility remains. While the paper price of oil fell today on diplomatic hope, the physical reality in the Middle East actually worsened. Reports indicate that regional crude output has been halved because the shipping closure has forced shut-ins at the wells. One open question investors are debating right now is whether today's move reflects a durable shift or if the market is underestimating how difficult it is to restart oil production once it's been forced offline. I'd be interested to hear how you are interpreting this. Is the physical supply gap a ticking clock that the market is currently ignoring? Let me know your thoughts in the comments. The broader macro signal here is a shift from blind panic to calculated hope. Investors are betting that economic pragmatism, the global need to keep trade flowing, will eventually outweigh military escalation. However, the macro fundamentals haven't changed. Inflation remains sticky at 3.1%, and manufacturing data is cooling. Today wasn't a regime change. It was a narrative adjustment based on the hope that diplomacy can cap energy prices before the Fed speaks later this week. That brings us to the ultimate stress test, the FOMC decision on Wednesday. This is the primary narrative shifter. If Chairman Powell ignores the cooling manufacturing data and doubles down on the energy inflation threat, today's relief rally will likely evaporate as quickly as it arrived. We are also watching the follow-through from the NVIDIA GTC event. The market needs to see if this new hardware roadmap translates into immediate capital expenditure commitments from the big cloud providers. The soft landing narrative has been resuscitated today, but its survival depends entirely on the Fed's tone and the actual delivery of physical oil barrels. The broader takeaway from today's market reaction is that while diplomacy has provided a temporary relief valve, the underlying physical supply crisis is far from resolved. Today was a tactical bounce driven by headlines. For now, the most disciplined approach is to use this strength to reassess exposures rather than chasing the move. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.